If you're following my channel, I'm guessing I don't need to remind you that dividends are a perfect way to improve your investment portfolio with passive income. A topic for which a large number of individuals are searching for during periods of high inflation and rumors of a deep recession. And with markets falling hard last week, it's presented a good chance to buy outstanding companies at much lower prices, providing a bigger return on your investment money. However, given the market's drop last week, certain companies and ETFs are now giving yields of more than 20%. This might be an excellent buying opportunity for people trying to make the most of dividends they can earn for their money. But we must be careful not to chase stocks merely because they have the greatest yields. My basic guideline is that if a company or fund provides a dividend yield of more than 12%, I generally exercise extreme caution. That does not mean I'm not cautious and don't conduct thorough research. However, the higher the yield, the more research I prefer to do on a certain company in order to know whether that company's dividend is going to be long-term sustainable. But with almost all companies, once you go above a 15% yield, it seems to be a dividend trap. These investments often have a track record of persistent dividend reductions. But today, we're going to discuss one investment in particular that a viewer asked that stands out from the rest of the investments I've seen. This company presents yields more than 20% and has increased its dividend annually for the previous 4 years. The stock we'll be looking at is OFS Credit Company, ticker OCCI. They're a non-diversified closed-end management investment company created in 2018. According to their website, the primary purpose of this stock is to provide current income, with the secondary goal of producing capital appreciation largely through investments in collateralized loan obligation or CLO equity and subordinated debt securities. OFS Credit was developed by OFS Capital Management, a Chicago-based full-service supplier of capital and leverage finance solutions to U.S. companies. They were founded in 1994 and currently manage roughly $3.1 billion in assets. According to Google, its stock presently offers an amazing 20% dividend yield to investors. As a result, I've seen some individuals wondering what the stock is since it's a tough investment to explain, especially if you're unfamiliar with CLOs and closed-in investment companies. It involves some quite complex types of investments that most people are not familiar with. However, I'll break down all you need to know about this stock and offer you with enough knowledge to evaluate if this is the type of investment you should pursue. And I'll provide my own opinion on it once we look at everything. So I believe the two most important things to remove from this stock's description are closed-end investment or CEF and collateralized loan obligations or CLO, and I'll begin with the former. OCCI is not your ordinary stock, such as Ares Capital or Sachem Capital. OFC Credit is a closed fund company, which is a publicly traded investment in a pool of securities such as equities and bonds. In many instances, it's similar to an ETF or even a normal mutual fund. But there are several key distinctions. Each closed-end fund is a different company. Vanguard, for example, owns many ETFs such as VNQ, VCI, and VT. All of these funds are part of the Vanguard group. But with closed-end funds, each fund is held by its own unique company. There may be one bigger company with many CEFs, such as PIMCO, but each of them has its own management group. This chart, which I am using, provides a great analysis of the primary distinctions between an ETF, a mutual fund, and a closed-end fund. Closed-end funds such as OFS Credit are actively managed, as opposed to most ETFs, which are passively managed. As a result, they frequently charge substantially higher cost ratios than an ETF or mutual fund, typically over 1% if not greater. CEFs also have a set number of shares since they have IPOs much like regular company stock, which is another reason CEFs vary from ETFs and mutual funds. Another way CEFs differ is that they include leverage, sometimes a lot of leverage, as I'll discuss later in this video. But all three forms of investments are organized as pooled diversified investments. Another key message from this fund's description is that it invests in CLOs, or collateralized loan obligation. I'll do my best to explain these complicated investments as simply as possible. But CLOs are simply a pool of leveraged corporate loans that are grouped together and kept into equity securities that funds like OCCI buy and put into their fund. If you are looking for high-yielding investments on a regular basis, you may be aware of several other CLO funds since they usually often give dividend yields of more than 12 to 15%. Oxford Lane Capital, ticker OXLC, and Eagle Point Credit, ticker ECC, are two popular CLO funds. These sorts of funds typically make investors nervous because if you've ever seen the film The Big Short, a counterpart to the CLO known as the collateralized debt obligation was shown extremely badly in the film. If you remember the part where Jared is discussing CDOs to Mark Baum and his team, you'll understand that these obligations are structured in a succession of tranches, each of which has a different rating from AAA to D, or even no rating at all. To put it simply, the corporate debt within the CLOs that OCCI invests in is ranked according to their perceived capacity to repay their loans. And the truth is that these funds, which include OFS Credit Company, Oxford Lane, and Eagle Point, are rated poorly, since interest payments are so much higher on lower-rated debt, which appears to mean that CLO funds can pay much higher dividends to their shareholders, which helps explain OCCI's massive high dividend yield. Let me know in the comments if you have any other questions about investing. Let's return to the video. Now, my purpose for this video isn't to attempt to explain everything there is about CLOs, since that will take a very long time. But I hope it provides a good enough understanding of how these things operate. While these sorts of investments intimidate many investors, there are many who recommend investing in them at specific economic times for a number of reasons. Unlike the CDOs in The Big Short, which dealt with consumer mortgages, their permitted investment increases diversification. The debt contained within CLOs is first-lien senior secured debt, similar to that found in a business development corporation. According to Fitch Ratings, the recovery rate for a company that can't pay its debt is 76%. So it's quite unlikely that one of these loans would be a huge loss if the company couldn't repay. But now that we've gotten that out of the way, let's take a closer look at OCCI in detail. According to Google, its current yield is more than 20%, and we can see from their dividend distribution history that they have been able to expand its payout from their existence. It used to pay the monthly dividends but moved to quarterly payouts in June of 2020. However, if we look at the share price history of OCCI from their IPO, we can find that their share price for this fund has decreased by more than 43% in less than 4 years. So what exactly causes the significant drop in share price? There's one issue in the recent OFS Credit's semi-annual report that I found extremely frightening. According to page 6, the CLO securities wherein we typically participate are unrated or graded below investment grade and are sometimes called as junk securities. In addition, CLO equity and its subordinated debt securities, for which we want to invest, are highly leveraged, with CLO equity securities generally leveraged 9 to 13 times, which increases our risk of loss on these investments. If you're unfamiliar with leverage, that's a lot of leverage, and the higher leverage an investment has, the greater the risk. So even when compared to other CLO funds available, OCCI may be the riskiest option. By looking at their most recent investment fact sheet on their website, we notice that OCCI has a lot of this higher risk debt. They don't have anything A-rated in their portfolio, and the majority of their investments are in extremely low B-rated debt, a little C-rated debt, and then 3.7% in debt that isn't even rated, so nobody knows exactly what it's in. However, as previously stated, the higher the risk, the higher the investment payouts these companies must make, which explains the massive dividend yield of over 20%. However, OCCI is also the smallest CLL fund when contrasted to Oxford Lane and Eagle Point, which means that as more companies default on their loans, the greater the negative impact on this fund. Another issue that has to be addressed is that not only OCCI, but all CLO funds, including Oxford Lane and Eagle Point, charge investors high fees. According to Morningstar, the average ETF fee ratio in 2019 was 0.45%. For index ETFs, the average expense ratio was 0.2%. According to Kiplinger, the average expense ratio for all closed-end funds is 1.09%, but Ops Credit has a fund charges an expense ratio of 12%, which means that for every $1,000 invested in OCCI, $120 will be deducted by fees, which is probably the highest I've seen so far for an investment, at least a publicly listed investment. But this is actually rather similar to Oxford Square and Eagle Point. Whenever you have an actively managed fund holding, these are very complicated investments. You're going to see some really high costs. However, you may argue that if the investment provides superior returns, all of these costs are justified. For example, if I was earning a high return on my investment, say 30% every year, I'd consider a 12% expense ratio to be worthwhile. However, based on the significant fall in OCCI's share price, it has not converted into a viable investment up to this point. This is when a drip calculator might come in help. I use this tool to calculate the total return of a stock, ETF, or closed-end fund. It's a great tool for demonstrating how well an investment has treated investors in the past. And while previous performance never guarantees future success, I still find a lot of value in how an investment has fared in the past. I often use this knowledge as a strategic plan to establish how I'm going to go with assessing an investment. But we'll look at the overall return of OCCI since its launch in 2018 and take dividends into consideration to evaluate how well this fund has performed. Over the previous 4 years, this fund has delivered investors a rather poor return. If you put $10,000 in OCCI when it first began, you'd presently be underwater with an investment total of $9,918.49. And keep in mind that this is with all of those very high dividends reinvested. Your initial 533 shares would have grown to 939 shares in less than 4 years, a significant growth. However, it is evident that the free-falling share price is the fundamental concern with OCCI. Your total return would be negative 0.8%, resulting in an average yearly return of negative 0.21%, indicating that OCCI hasn't been doing well up to this time. However, if we are indeed headed towards a recession, which appears to be the case, then how would CLL funds perform overall? Were they better or worse investments? How do they normally behave during March market downturns? Fortunately, Eagle Point Credit Company's newest investor presentation includes a chart that indicates how well CLL equity funds have performed over the previous 30 years. This figure depicts the total return of the Credit Suisse Leveraged Loan Index, or CSLLI, and we can clearly see that if a recession occurs, the future looks bad for CLL funds. The reason why I say this is that when comparing CLOs to the performance of the S&P 500, CLO shares tend to outperform the market. For example, according to macrotrends.net, CLOs lost 28.8% in 2008, while the S&P 500 lost 38.49% that year. This year, CLO equity is only down around 2.7%, while the S&P 500 is already down approximately 15%. However, remember that this is the index's performance. Ops Credit invests in CLOs that are more riskier than the average. If OCCI replicated the Credit Suisse index, it might be a potentially profitable investment. However, Ops Credit invests in riskier equities than other CLO funds. To sum up, despite the insanely high yield, when we consider the share price performance, the expense ratio, and the dangers involved, OCCI is an investment that does not appear appealing to me. You are welcome to disagree, but that 20% dividend return just isn't worth it in this case when you will be paying sky-high fees while losing a large portion of your initial investment. I'll keep an eye on this fund, but I'm not holding out much hope for a reversal anytime soon. And as always, before investing in any security, conduct your own research and due diligence and reach your own conclusions. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.